Subscribe our channel eFinance Management and click on the bell icon to get update on new videos. Today we are going to explain external sources of finance. External sources of finance are those sources of finance which come from outside the business. For example, retained earnings are an internal source of finance, whereas bank loan is an external source of finance. We can segregate external sources of funds between long-term sources of finance and short-term sources of finance. Long-term sources of external finance are equity shares, preferred stock, debentures, term loan, venture capital, leasing and hire purchase. Short-term sources of external finance are bank overdraft, trade credit, factoring of debt. Equity shares. Equity shares are a common source of finance for big companies. Not all the businesses can use this source as it is governed by a lot of legislations. A key feature of equity share is the sharing of ownership rights, and therefore, the current shareholders' rights are diluted to some extent. It is considered costly compared to debt finance because the return in the form of a dividend or bonus shares offered to shareholders is not tax deductible. Debentures. Debentures are another common means of finance used by companies who prefer debt over the equity. Debt is considered to be the cheaper mode of finance compared to equity. It does not share control with investors. It is because the interest paid to debenture holders is tax deductible. Rest of process of debentures issue is similar to equity issue. It is offered to the common public and therefore necessary legislations need to be complied with. Debentures also involve some cost of issuing and they are collateralized by some assets of the company. Term loan. The characteristics of a term loan is very similar to debentures, except that it does not include too much cost of issuing because it is given by some bank or financial institutions. The common public is not involved in it. A rigorous analysis of companies' financials and future plans is done by the bank to judge the debt servicing capacity of the company. These loans are also secured by some assets. Preferred stock. The preferred stock shares characteristics of both common equity stocks and debt. They are called preferred because they have got priority over common equity shares in terms of payment of dividend and the capital also at the time of liquidation. A special kind of preferred shares called cumulative preference shares has its dividend accumulated till it is not paid. The payment of such dividend can be delayed but cannot be ignored. Venture capital. It is same as equity shares except that the investors are a different set of people. Commonly known as venture capitalists, they normally invest in a new company at an initial stage and do a rigorous analysis of a company before investing. Venture capitalists exit the firm once it starts getting a good valuation. Leasing and hire purchase. Choosing hire purchase or lease as an option over paying the full amount to the supplier of goods can help businesses delay its cash payment, which is equal to having its goods financed. Normally, the hire purchase option is provided by suppliers of big machinery or bank becomes an intermediary at times. Both lease and hire purchase provide the buyer with an option to purchase the asset at the end of its term. Short-term sources of finance are bank overdraft. It is a simple mode of short-term financing. Businesses need money for their day-to-day requirement which arises due to a time gap between their collections and payments. To fulfill such requirements, bank overdraft is an ideal short-term source of finance. Trade credit. Trade credit is nothing but the credit given to a business by their creditors or suppliers. It allows a business to delay its payments by some period. The period of credit depends on the credit terms between the business and the suppliers. Factoring of debt. It is an arrangement whereby the business sells its account receivables or debtors at a discount. In this arrangement, the buyer, who is known as the factor, collects the money from the debtors on behalf of the business and charges a premium for this service. If the debtor does not pay for any reason, the factor can get back to the business for the payment. Thank you. Please subscribe, like, and share our video.